The markets in 2023 may present a once-in-a-generation opportunity for you to build wealth for your future. The ways to building riches out of recessions are pretty simple, but they're difficult to actually do for most people. Here are the opportunities that you should try to capitalize on in the near to medium term future. And yes, this could really be happening. 91% of CEOs are saying that they are forecasting a recession. Most of the major Wall Street banks are calling for one in 2023. We're already starting to see massive layoffs in certain sectors of our economy. And I can tell you from talking to people that operate businesses in several different industries, things are slowing down out there. And fast. Not to mention, the yield curve is totally inverted, which almost always leads a recession. The Federal Reserve is still hiking interest rates, even as the stock market is currently down. That almost always leads to recession. I think you get the idea here. If historical trends repeat themselves, and we get a major recession here and then a major recovery thereafter, it's gonna be possible for you to set yourself up for the rest of your life taking advantage of some great investing opportunities. I think the way Warren Buffett phrased it was to be greedy when others are fearful. Let's get into what this could look like in the next 6 to 12 months in ways that you could benefit by positioning yourself well. And if you want to see all the trades that I'll be making every single day during this market crash, just subscribe to my Discord channel for the low price of $199 per month. Just kidding, but you should subscribe to this YouTube channel for free. I'm gonna skip all of the academic jargon and make a long story short. In recessions, people spend less money. And when people spend less money, companies post smaller or even negative profits. And declining or negative profits hurt those companies' stock prices. Hundreds of companies have already started to reduce their earnings forecasts for 2023. That, along with a few other factors, have caused the S&P 500, the stock market here in the US, to decline by as much as 25% at one point this year. But if things were to get worse than many of these companies have predicted or baked into their earnings, then you can see their stock prices get a lot worse as well. If we look at other bear markets throughout the last century, the average decline from the peak to the low in the big stock market indexes is about 30%. And these declines typically last between 18 to 24 months. In the most extreme cases, the stock market has dropped by more than 50%, which is like when total fear takes over most investors. And that type of an environment is exactly where the best opportunities lie. I'm gonna cover exactly how much you can make investing out of an environment like that. But first we need to talk about how markets get to those low prices because we never really know where the bottom is going to be. Maybe the 25% decline was the lowest we'll get. Sometimes it'll drop 30, 35, 40, 45%. You see where I'm coming from. You see, during economic recessions, as stock prices are typically trading lower, they don't go in straight lines. If the stock market just went straight down 50% and then right back up to where it was, I'd be running a multi-billion-dollar hedge fund and I probably wouldn't be making this YouTube video. Maybe I still would. The point is that markets are choppy. And many recessions in the past have seen stocks bounce lower, then higher, then lower, then higher, then lower throughout the downward trend. Since we can never know exactly where the bottom of the market is, if you want to be buying stocks, you need to be able to do that periodically throughout a declining market environment. And the only way to be able to buy periodically is to have the cash available or new money coming in the door that you can afford to invest. It's not going to feel good in those moments to invest in a stock market that is down and maybe declining even further. But you should think about stock prices in a recession as being on sale. Now, if you go to a shopping mall and you walk into a department store and everything is 50% off, you love it. You're really happy you're there and you're excited to spend your money on just about anything you might want. But because we human beings are emotional creatures, we suffer from several cognitive biases. When the stock market is 50% on sale, most people don't want anything to do with it. But again, a 50% decline would be historically huge, and that is where the market has always presented the most potential future opportunity. Because after every bear market has come a bull market. One study reported that in the calendar years following a year where a recession was announced, the stock market averaged returns of 40% in that year. And then if you include 2 years after the year where the recession was announced, you saw a total of 58% average return over those 2 years. And even in some of the longer recessions of the past, the market has still totally recovered from them. To cherry pick a really good example for this, if you had, say, $100,000 of what I'll call dry powder between maybe a 401k, a Roth IRA, and just cash or an emergency fund that you keep on hand, and you chose to invest this $100,000 into stocks at the bottom after the last big recession, which was in March of 2009, and you held those investments after your original purchase of $100,000 through the recovery and the subsequent growth and all the way up to the peak of the market about a year and a half, 2 years ago, your investment would have grown by 14x. That is, your 100,000 US dollars became 1.4 million. Depending on your lifestyle, 1.4 million could be enough to retire on, so yeah, this type of growth out of recessions is exactly how the rich get richer. But to take advantage of this huge upside potential, you have to be willing to invest your money when most other people are not. Because at market bottoms, things look really, really ugly. And you can't really rely on the media or the government or even economists to tell you when the recession is starting or ending. Because actually most markets start their recovery just a few months after the recession that market has declined during is formally announced. So they're like a year to 2 years late in telling us that we're in a recession most of the time. So one way to combat this is to be buying stocks at each lower level. Saving money periodically into your 401k, as a common example, maybe your Roth IRA if you're eligible to do that, or just potentially cash that you've kept on hand because maybe you knew a difficult economy was ahead. All of those things can be beneficial if you are considering deploying money into the stock market during a recession, and they can be especially beneficial if you're worried about maybe losing your job, which unfortunately is a really common outcome of environments like we might see. Then you typically want to invest for the long term and keep investing throughout the market rise on the way up. You just need to know what risk tolerance you're comfortable with. To use the same example, during part of that recovery from 2009 to 2020 was like a 20% drop in 2011, a 20% drop in 2015. If you do have your portfolio in 100% stocks, which would be relatively aggressive compared to most, you're gonna see some pretty big swings in your account value. And if you're uncomfortable with that type of risk, you should consider diversifying into other and sometimes safer other asset classes and holdings. My own personal plan is to start buying stocks pretty aggressively if the S&P 500 hits levels 30%, 40%, and then especially 50% from the highs if it were to get that bad. And when I say aggressively, I'm probably talking about leverage, and again, this is just my own personal situation. I definitely am not recommending this to anyone watching this video. But I'm just gonna tell you, if the S&P 500 is down 50%, I'm gonna consider using some leveraged ETFs or maybe even some long-dated call options on the market because, like I said, markets always recover. And to me, I'd be fine with very, very drastic swings in my account value during a period of time where I have a high degree of confidence that I'm gonna see growth in the future. But again, these ideas are extremely risky strategies and products. You could lose a lot of money using those things. Make sure you do a lot of research on any of the few things I just mentioned before you would ever actually consider doing those yourself. So if this all pans out well for me, and 10 years from now I'm a billionaire, which is extremely likely, I will guarantee a gift to you and a gift to a charity of your choosing of $50 million apiece as a donation of 10% of my billion-dollar net worth. So hope you all become a billionaire along with me 10 years from now. As always, thanks for watching.